Hello, friends. Welcome back to Market Shares. I'm your host, Tony Blodgett, and today we're going to go through another little market update. I mean, holy cow, the volatility that we've seen over the last few weeks is incredible. So I want to talk a little bit about what's been going on, what's been creating some of this. Obviously, the tariffs have a lot to do with it. We are not surprised by this, but we saw what I think is the most volatile week in the stock market just last week. It recovered a fair amount, so that's good. Things seem to be stabilizing. The bond market is starting to recover a little bit, but man, the bond market had a very, very poor week. We're going to talk a little bit about that as well. And then, are things going as planned? The Trump administration, started off this journey of increasing tariffs. And let's talk about, is it having the intended consequences and what might be the result of some of that? So we'll get to that towards the end. But we did have CPI come out last week, and CPI, the consumer price index, is, typically a market mover. Matter of fact, usually when it comes in, the core inflation number in CPI was 0.06 for the month, which is a very low number. Down from 0.26 just the month before. And typically that would create some sort of a rally in the bond market. Obviously giving the Fed perhaps what it needs to be able to be more aggressive at lowering interest rates, because inflation is one of their main concerns. But this came out without much fanfare. The bond market was so entrenched in what was happening with the tariffs and everything that it kind of looked like it just kind of shrugged it off. Now, I think this is good news. It's not the Fed's favorite measure of inflation, as you know, but it's definitely something to look at. Now, even more, if you dig deeper into CPI, you can see that the majority of the small amount of inflation that was in CPI was from shelter and car insurance. We've talked about these. Shelter, it's coming down, but not as quickly as anyone thought. Car insurance is still, astronomical. But if you were to strip out shelter and the car insurance component of CPI, the year over year CPI would be 1.5%. It's much lower than the Fed's 2% target. And obviously you can't just strip those out, but it is interesting to look at that everything else, is very much under control as it relates to inflation. Now, why did the market just shrug this off? Well, partly because it was based on last month's data. And what we didn't have last month was the tariff talks, right? And so I think that it kind of was taken with a grain of salt. We will need to see this sort of inflation number continue in order for it to really have a meaningful impact. But it is going to be good for the year over year number to have such a low read for the March number. So anyways, all in all, CPI definitely where we would want it to be, but not necessarily having the impact that we were hoping for. A couple other just stats that I read. CEO confidence is worse than ever. If you look at a chart of CEO confidence, if I can find it, I'll throw it up here so you can see it. But it's as worse as it's been in a very long time. Obviously, again, lots of concerns about what is going to be the impact of these tariffs, and consumer confidence is still very low. We talked about this on my last market update. That trend is continuing. So, a lot of just uncertainty in the market. Wage growth, though, is also down, down pretty significantly. The trend is down. It's pretty flat right now. But wage growth being down, the Fed's not going to love that, right? Because part of their mandate there is maximum employment, but that includes, a living wage for people. So with wage growth being down, that's not great, but it does help the inflation situation, right? When wage growth goes up, that tends to be inflationary. So kind of weakness, not so much in the jobs numbers, but you see it in the wages coming down. Now, let's talk about the bond market last week, because It was crazy. Now, we saw the stock market obviously tank multiple days in a row and then had, I think, the largest recovery it's seen in, I don't know about ever, but I mean, it was a 2,300 point gain in one day when Trump came out and said he would do the 90-day pause on the tariffs. And he takes a lot of credit for that really good day in the market, but really it was just kind of unwinding the tariffs that he announced earlier that week. So I don't know how I feel about that, but nonetheless, it was nice to see that large of a recovery in the stock market so quickly. It really gave me a memory of what happened in COVID. That real V-shaped pattern got created by that. And we're not back to where we were. I think the stock market's just over 40,000 right now. It was about 43, 44 when this all started. So a little bit more room to go to fully make up for everything that was lost in the stock market, but it made a good amount of recovery in a short period of time. But typically, when you see the market tank like that, you would see that money flow into bonds. And you know, it's not that we didn't see that happen. I think we did, but there's a few other things going on with the bond market. Now, it's widely, been discussed, I guess, is China and other countries, are they unloading their holdings of U.S. bonds? I mean, that's a lot of people I've heard say that. I have not seen any strong evidence that that's happening. And matter of fact, watching an interview yesterday with the Treasury Secretary, they don't really think that that's happening. Matter of fact, he pointed to the really strong auction that we had last week, and there was a lot of foreign participation in that auction. So we're not sure that that's what's happening. But what could have happened is that when there's a large sell-off like that in the stock market, there's going to be margin calls. There's going to be need for liquidity. And usually bonds, treasuries are the place where people, those holdings are very liquid. And so we probably saw a lot of liquidating of those in order to create cash to cover margin situations or just really to fund reserves, perhaps, in situations like that. So I think multiple factors contributed to the bond market doing what it did. Now, here we are in a new week, and we are starting off the week. I'm recording this on Tuesday. We're seeing the bond market, mortgage-backed securities specifically, are recovering. So is the 10-year. But let's talk about the volatility we saw last week, because this is crazy. I looked at the candlestick charts for the 5.5 Fannie Mae coupon, and although it didn't close at these levels, the intraday, the wick, if you will, on the candlestick went as high as 101.12 and as low as 97.69. That's a 343 basis point swing, right? Or 3.43 points, 343 basis points. You guys, that's a crazy swing in a 5-6 day period of time. I think that went back looking at the Friday before until the Friday of last week. And that was a massive move. I hope everyone's pipelines were locked, because otherwise, we got some difficulties out there. Trust me, I've looked at pipelines. They're not all locked. I'm sure people are challenged with that. What a good reminder that we're just not in a season where you can float interest rates given this volatility. But nonetheless, here we are sitting today with the 5.5 coupon at 99. So we've definitely recovered from that low, the low watermark of 97.69. So we're up at 99, moving in the right direction, but we need a lot of recovery to happen in the bond market in order for rates to get back to where they were. And with all this move last week, and with inflation looking good, the chance of the Fed doing a rate cut at the June meeting has increased from 0 to about 30%. So you're saying there's a chance. It looks like there might be a chance of the Fed doing something. I think there's still some more time here for things to unfold. That is something we'll be watching closely. I think a lot of people are feeling like the Fed needs to make some sort of a move at this next meeting, start getting ahead of this with everything that's going on and all the concerns in the market. Will they do that? I don't know. I think the way that Jerome Powell's looking at this is like, look, hey, we have our strategy. We're not changing our strategy. If the administration wants to do these tariffs and do their thing, we're going to continue to look at the same data that we've been looking at, which is inflation and employment numbers. And until they see those numbers move significantly, they're not going to take much action because of the CEO confidence or the consumer confidence or the fact that home buyers are having to pay such high interest rates and it might impact the housing market. They've indicated multiple times that they don't care about those things, and they're certainly not going to take any sort of direction from the administration on their monetary policy. So I don't know that I expect them to acquiesce because of what's going on in the market, but time will tell. But the people who predict these things are suggesting a higher chance of that happening. Hedge fund shorts are way up. That means that, the big hedge fund traders see more potential sell-off in the stock market. I think that, now if that doesn't happen, we could be into a short squeeze situation. We could see, that could put pressure on bonds again, right? Needing to liquidate some of those funds. So lots of things that can create volatility. Again, a reminder as a mortgage professional, why you need to quote your client a rate and lock it. Hopefully you have some sort of, float down or renegotiation policies at your organization. This would be a time to lean on those if we see a significant improvement in rate, but don't risk, this kind of big drop like we saw last week happening to your client in the middle of their transaction. So one last thing I want to touch on is Jerome Powell and how, there's starting to be some talks that apparently President Trump has inquired as to his ability to remove some of these positions, people that are in these positions like the Fed chair and whatnot. These are rumors. Whether or not he's going to take action, he's already said he has no interest in removing Jerome Powell from his position. Jerome Powell made it very clear, like, I'm not going anywhere. He's got, I believe, about a year left on his current position as the Fed chairman. So I don't expect anything to happen, but let's look at the three things that Trump really wanted to make sure stayed in place as he entered into these tariff talks and what is really ramped up to a trade war, of sorts. And the three things that he really wanted to see happen, the first one was energy prices to come down, right? Oil, gas, etc. I've talked about this for a year on this podcast. I believe that that's going to happen. And in fact, it is happening. So lower gas prices, lower energy prices, good for inflation, good for the average household, right? It just helps bring down the cost of things in general, because so much of what we spend is in those areas. So that's happening. Check. Okay. The second thing is he wanted the dollar to go lower. And this doesn't sound like a good thing, but it really does help us in offsetting any tariffs that might be put upon us, retaliatory type of tariffs and whatnot. So a lower dollar, he wanted that. We're getting that, for better or worse. That's what he wanted. That's what we're getting. So check on number two. The third thing, and we've talked about this a lot, is a lower 10-year, the 10-year treasury to come down. That, on the other hand, is not happening. It started happening. As you saw, we poked all the way down to like 3.8, but now we're up at like 440, 435, somewhere in that neighborhood, 445. I don't know what the exact number is this morning, but nonetheless, it's going in the wrong direction. And that's where you might see Trump say, hey, I got to get involved here. There are some things, as I've mentioned before, that the Treasury can do to help bring down the 10-year, and I think Bessent is committed to trying to do that. But if you continue to see Jerome Powell not take any action here, then I wouldn't be surprised to, at minimum, see the rhetoric from Trump start going up significantly on, how he talks about the Fed and what they should be doing. And I only say that because that's exactly what he did in his last term as president. So you should not be surprised by that. But that's the minimum I think we're going to see happening. The worst case is he does try to find a way to get Jerome Powell out before the natural time that he's done with his term. And, that could be messy if that happens, but obviously he would want someone in there that's going to follow his agenda a little more closely. Now, do I think that that's a good idea? I'm sure as a mortgage person, it sounds pretty cool, but do we really want someone at the Fed, who's really supposed to be non-political, to then have this alliance with, the administration. I think a lot about why we have multiple different branches of our government. Not that the Fed is one of those branches, but kinda. They should be independent, and it shouldn't be political. So I do have some definite concerns if that's the direction that Trump goes. Probably would bring down interest rates. That would be the whole point of doing that, right? But is it the right thing to do? Probably not, but we'll have to see how that unfolds. But it's just interesting that we are even hearing that sort of talk happening. That wasn't happening a month ago, and now it's something that's been kicked around. The last thing I want to talk about is how I said Jerome Powell was the last thing. The very last thing is housing. Here's what's interesting. So obviously I get concerned about what's going to happen with the housing market with interest rates spiking up like they just have in the last week. And we already know affordability is super high. But here's what's interesting is that mortgage application, even just over the last 2 months, when we saw rates improving, you guys, the activity went through the roof. And that was still at very elevated interest rates, not where they're at today, but still very high historically speaking. So just imagine what is going to happen in the market if we do get rates to where many people are predicting we get through this tariff war. If we continue to see low inflation, as people have predicted, gas prices keep coming down to help offset that. All these different countries negotiate with the administration, as he's hoping that they will. And as a result of all that, we do get lower interest rates. And, if that happens, I think that the real estate market just goes on fire. The fact that we've continued to see appreciation year over year, we've continued to see mortgage applications up, just with every little dip in interest rates, mortgage applications spike. So that just tells me there's a ton of pent-up demand that's just waiting for something to happen, waiting for affordability to get a little bit better, waiting for interest rates to drop a little bit. And that doesn't even get into all the refinance opportunities that are there as well. So you guys, I'm still very bullish on housing. I just want to put that out there because most of the people watching this care about housing. So you watch those little underlying things that happen every time the market takes a blip and you see applications spike up. That to me is pent-up demand, and we'll have to see how this story continues to unfold. And I'll continue to bring you these updates every few episodes or so. I'll jump on, just talk about what I'm seeing in the market, and feel free to leave your comments down below. Let me know what you think. Let me know if there's any other areas you want me to touch on in this podcast. I'm happy to do that. We have some cool interviews coming up as well, so stay tuned for those. And if you're not already subscribed, please consider doing that. And then keep in mind, every Friday morning at 10 a.m. Pacific time, we do drop a new episode. So you can always look forward to some casual watching of market shares, every Friday or over the weekend or whenever you have time to catch up. And more importantly than subscribing is letting people know about it. Spread the word about what we're doing here at Market Shares. I'd sure appreciate it. And until next time, take care.